I really sucked at trading when I first started out, but over time I discovered things about supply and demand that are the foundation of what makes me a successful trader today. And I want to pass on to you the 5 concepts that really make or break a supply and demand level. I'll also show you my strategy that made me over $9,000 in 1 month, trading 90 minutes a day, 4 days a week. And if you can use these 5 concepts every time you draw supply and demand levels, you are going to find levels that hold a lot more often, which will in turn make you a more profitable trader. Let me explain to you these concepts from the ground up so you can go from a wannabe trader to knowing exactly what you need to do every single day to make consistent money. The whole idea of supply and demand is you are looking where previous buying and selling has happened that shows a clear indication that the larger banks or hedge funds are buying at those levels. And what you can do with this is looking forwards into the future. When a chart gets there, you can assume that it's more likely to bounce off of one of those supply or demand levels. Like anything in trading, it's not going to work every time, but what you can do is use it to increase your odds of success. Now let's go down the list of the 5 things I look for every time I draw a supply and demand zone. If you don't follow these, you are more likely to draw worse zones, which is more likely to make you lose when you trade off of them. The first one of those is looking for 2 clear swings in the chart you're looking at to draw your supply or demand level. What this does is really give you a confirmation that the market is likely to bounce off of that area again. I found over time it's not profitable to draw off of one bounce because it's not confirmed that the market actually likes that level. It's more like to break through that level because it's just not as strong. Now, the one that makes most traders fail is drawing too many levels. You do not want to have your chart have lines all over the place. What you want to do is take those away and not focus on them because they're more likely to get you into areas where you think the market's going to bounce and then the market just blows right through that area because you're not sticking to an extreme level in the market. This area right here is just in the middle of this overall range that the market's currently in, and so it's less likely to bounce. A lot of traders want to do this because they think it'll give them more trades. And when you start out, you want to take a lot more trades because you're excited and you think that's what makes you successful. But what has made me more successful over time is sticking to the more extremes in the market, which makes me take less trades, but they're more successful. And then through scaling over time, you can make more profits. And now just looking at these, you can see the market doesn't bounce off these levels that often. And so what I realized over time is that you want to draw your supply and demand levels like a zone. The market's not going to perfectly touch a line that you draw on the chart every time and bounce off of that. What you need to do is instead think of these like a zone. It's a supply and demand zone. Down here, we have a really good demand zone where the market is coming down here a couple times. And then we could assume, okay, when it comes back down to this area in the chart, it's likely to find buyers again. And what happens, why this happens a lot of the time, if we just zoom in on this, is that because everyone else is looking at the same thing. They see that, okay, the market's bounced here before, and either the big banks or whatever is coming in and buying it here, it's coming in and saying, okay, I really like this price down here, but you know what? I like this price here too, and up here. And so it's the area they're willing to buy. And when the price comes down here again, well, if the stronger that the market is, the more likely it's going to just dip a little bit and then take off and reverse from there. And so that's why sometimes you can see that it will reverse really early in the zone, right above the zone, or below the zone. Like if we go back to these swings right here, there's 2 clear swings right here, and you can draw a zone here. And you can see that the market broke out of the zone a little bit, but still failed inevitably. And the same thing, if you just extend that over here, well, it's still a zone. And so every time it came up into this zone, the market still reversed off of that supply zone. Every time the market got up here, people were wanting to sell it. And you know, it's okay that the market broke out of it a little bit because sometimes the demand is a little bit more than before, and it just takes a little bit more selling pressure or time for the supply to overtake that demand. You know, it's all about that economics of that kind of balance between supply and demand. Sometimes there's a balance and after a while, then it sells off from there. Now, one thing that I've realized that really can make or break a supply and demand level is looking at the velocity of the market when it sold off from that level, when you're identifying it. So if we're trying to identify this zone up here, this is a great example of the velocity of the market when it sold off from here. You can see, looking at these, look at the candlesticks of the sell-off from this area up here. There's 3 massive candlesticks selling off from this level up here, and it continued to sell off from there. But that's what we want to look for, is what is the initial sell-off like? Because that shows you when the supply for this supply level up here really came into play. And you can see it happened again right here. The market sold off very quickly with almost no pullbacks. It's not like it sold off kind of like this, where it was a more consistent, methodical downtrend. It just ripped lower. And so that, for me, increases the probability as we watch the market come up here for the 3rd time that yes, I can be confident in this level, and that I can look for key aspects in the market to signal to get in, and then it's going to reverse from this zone. That's something we'll get to into a minute, but you can see that's what really helps create these levels, is the velocity off of those zones. To show you an example where there's not much velocity, is you can see the market bounced here multiple times and eventually, moved up from here. And so based on that, it's a pretty good zone. You can see the market bounced here multiple times, but if we go forwards in the chart, or I just zoom out so we can see what happened when the market came down to this zone, is the market just blew right through that. It did kind of come here and bounce a little bit initially, but eventually it just blew right through that. And so, that makes it so it's less likely to hold. Now, of course, it could have totally bounced here, and that's why you want to take these with a grain of salt sometimes, is it's not a steady and fast rule. But what I found is looking for, that velocity in the sell-off, I think makes it more likely to create a level that you can trade off of. And so this only has one swing, and so sometimes your zones can actually be really large. And so what I mean by that is, look here, is there's no swing up here for a while. And we don't see anything here yet. The market kind of came up here, made basically a head and shoulders pattern, had a big reversal, and then came up to this head and shoulders pattern area again, and it sold off. It, took a little while to lose that momentum, but it eventually sold off. And so at this point, I would say, yeah, I think there's some kind of zone up here. It's really large, and so I'm going to be careful and wait for a really clear setup, because when a zone is that large, you want to be careful and patient in what the market's doing. And so the market comes up here again, and so you can see right here, it gets close to the highs of our previous head and shoulders pattern. And so how do you now decide, okay, well, I want to get in and bet short here? How do you end up getting in at these levels once you can identify them? And so the last big key with your zones and levels is draw them on a larger time frame chart. And so that's what we're looking at here. We're looking at a larger time frame chart than when I trade. This is a 15-minute chart. Normally I trade on a 1 and a 5-minute chart, and you can do this kind of on any time frame. You could do a 30-minute chart. These levels pretty much look the same on a 30-minute chart. It just kind of drowns out some of the noise and back and forth, but you can clearly see swings and draw zones off of those swings. And so that's what you want to do. And then what I do from there is I essentially zoom in on this point on a 1-minute chart. And so if we flip over to a 1-minute chart to give you more details, this is a 1-minute chart of the oil futures, and we're on the NinjaTrader platform. And so you can see now we're butting into that zone that we have drawn from a larger time frame chart. And so I'm expecting that, okay, the market's going to slow down here, and I want to look for a reversal opportunity. And so you can see the market's been really choppy here. And so how do you decide when to take a stab at this? The first thing I want to wait for when there isn't a lot of movement like this is I want to start to see the market actually starting to move. And so the market started to get some movement here. It kind of broke that previous low. Now there is kind of, maybe you could draw a minor demand level down here where it might bounce off of, but once the market comes up to here again, I'm going to be looking for a potential reversal. Now, it can be scary jumping into a reversal against the trend. And so that's the trickiest part about a reversal strategy, is knowing when to get in. Spotting these supply and demand levels is the foundation of this kind of trading strategy, and my trading strategy here. Knowing when to actually jump in on a trade at these supply and demand levels is probably the hardest thing about trading off of supply and demand levels. I have created a 4-step entry checklist that I look for every time I jump into a trade. And so the first one of those is you want to make sure that uptrend is broken. When you're looking at an uptrend and it's making higher highs and higher lows, well, you don't want to get in betting that the market's going to go down when it could just continue to do that. And so that's the first thing I always look for. I want to look for it to break that uptrend if there's an easy trend line that you can draw, or just looking at it making lower highs. And so that's exactly what I'm looking for here first when I'm looking to jump in on a trade here, is I want to see it break this uptrend line. You can see it's made, if we just zoom in a bit more, it's made 2 clear moves up here, and I want to see that trend start to slow and start to break. And so right here, it's broken that. And so to jump into the recording of the actual trade I took in this spot, this isn't just some random spot I've pulled up on the chart. This is an actual trade I have taken. And so again, you can see I have that trend line drawn. Here is our supply zone that we're looking at. And so the next thing is, well, a big key that I actually liked about this specific spot is you can see, look at this big bullish candlestick here. Now, this isn't necessarily in my checklist, but it's something that I like to see and kind of confirm. So, maybe it is in my checklist, but I like to see the market lose its steam, essentially. I like to see it make a big attempt to go in the direction I'm trying to reverse against, and then that fail. And so this big green candlestick, for me, it shows that the market tried to make a big move up and then it got immediately rejected. And the velocity, if we go back to that, you can see right here, it's moving methodically, and then all of a sudden, boom, the market just shoots higher and it hits into our supply zone and it pushes it lower. And so that's telling me suppliers are coming in, and it's more likely that the market is going to lose steam here. Now, at that point, it hadn't really broken our uptrend. It started to break it a little bit here, but trend lines are just imaginary at the end of the day, right? You got to almost treat trend lines like zones as well. And so because of that, well, I want to see it make a clear break of that. And so I like to see multiple candlesticks out of that area. And then of course as well, I wanted to see it make a lower high because I want to wait for the market to really show that, okay, a high has been put in, it can reverse here. And so the market pulled down here, started to push higher and make an attempt to keep going higher. And sellers came in and said, no, we like this spot, we want to jump in, and the market lost some steam. And so it essentially made basically a double top here. And I saw after these kind of 2 candlesticks, it had given off that level a bunch. And if we go back to where I actually entered, I had a order below this little low here, because sometimes the market likes to make a little pullback and then go up. And so I elected to wait for the breakout of this micro low here. That's kind of a small technicality, but that's when the market broke below there. I filled in on the trade, and then I just put my stop loss up here. The whole idea of keeping my stop loss above this swing is that, well, if the market breaks here, that's breaking, my whole concept is trading with the swings in the market. And if it's going to make a higher high here, well, I think that it's less likely that I am correct and that the market's going to sell off here. And so I want to jump out and just take my losses. I go for a 1 to 3 risk reward ratio on this trade. I'm risking about $600. That's where my risk is right now. And so I go for, I'll lose about $600 on a trade, but then I go for 3x my risk. And so generally that's about $1,800. That's what I like to target, because then you don't have to be right very often. Trading's really hard. And even with all this in your favor, you're not going to be right all the time. And so with this, even if you're right just 50% of the time, you're going to consistently make money over the long run if you are able to consistently hit 3 times your risk and just, lose a fixed amount every time. And so you never want to move your stop loss once you're in the trade. Just let it hit it and get out if that's what the market is doing, and just move on to the next trade. I have found the best trades like this one go in your favor really quickly, and they give you easy money. And so this trade, I moved to break even once it started getting going here. And all of a sudden here, it just goes ballistic. And so that's why I actually don't have a profit target. You can see here, I get out based on just my stop loss. And you know, I kind of have an imaginary stop loss at some point. And so once the trade gets to about 3 times my risk, about $1,800, you can see here, is I move to the previous candlestick, because I don't want to let the market pull back on me. You know, I want to move and trade with the price movement and the idea of that, but at the end of the day, you got to think that also the money is important, because you can see right here, this is why I don't have a profit target. The market went insane all of a sudden, and this is why I love this strategy. Sometimes this can happen, and this massive bar here happened. And so what I did, you know, in the moment as I'm trading, I'm freaking out. I'm like, I can't let this pull all the way back and have my stop right here. I'll move my stop to, you know, about midway in the candlestick. It'll allow a little bit of a pullback, and maybe it'll keep going down, you know, a little bit of wiggle room. But I'm up so much money on that. You have to close it out there and move on to the next trade. You cannot get greedy with your trades and see when this happens and hope that it's going to keep going down. You know, sometimes it can, but if you see here, if I zoom forward a little bit, is the market started to bounce here. And so getting out down here was really smart, because we're at a demand zone down here. You can see I've drawn. And so that increases the likelihood that the market's either going to slow down and potentially reverse. And so you have to get out of your trade then. Now, if you like this strategy, I have videos where I walk through my whole month of trades. I show you what works and what doesn't, and it will allow you to master this strategy even more. You can't just learn it off of just one trade. Every trade in the market is slightly different. And so check out this video if you want to learn and really master this strategy.